Coming up on Business Incorporated. Central Bank of Kenya issue new rules to digital lenders. As the world celebrates 10th Global Money Week, take a look at Nigerians preaching financial literacy. Plus, Egypt plans to raise about $500 million with its first yen bonds. Hello, welcome to the program. I'm Ladi Williams. First off, let's take a look at the markets. Trading day in Africa kicked off the midweek on a negative note. Nigeria's main index down about 0.04%. Also, South Africa's benchmark index is in the red, down 0.35%. Elsewhere, Egypt's index also traded lower by 0.34%, breaking yesterday's bullish trend, while the Nairobi Stock Exchange closed Tuesday positive, up 1.11%. And over to the Middle East, sentiments were mostly positive. The Abu Dhabi index is up 0.50%. Dubai also in the green, up 0.16% at intraday. Still within the region, Saudi Arabia's index inched up 0.06%. And the Qatari index jumped by almost 1%. Now let's take a look at what's happening in Europe. Global bond markets are in the midst of their sharpest sell-off since the 2008 financial crisis amid fears over soaring inflation. Now let's bring in Chelsea Delaney right there in Berlin. Great to have you, Chelsea. So how are debt markets in Europe being impacted by this?
Well, it's not every day that bond markets are in the spotlight, but when they are, it's usually a sign that there is a big shift underway in the global economy. That's definitely the case right now. Bloomberg has a bond index that tracks bonds around the world. That has lost $2.6 trillion in value from its peak last year. Europe is definitely feeling that pain as well. One JP Morgan index of European government bonds is down by about 5% so far this year. Among countries that use the euro, Italy and Greece are definitely going to be the biggest concerns here. Greece's benchmark bond yield has risen by almost 2 percentage points this year. Italy's up by about half that much. But that means it's getting increasingly expensive for those governments as well as companies and households in those countries to borrow money. At the same time, the European Central Bank is winding down its nearly 2 trillion euro pandemic bond buying program. That program has been really crucial in keeping interest rates low. That's been allowing governments like those in Italy and Greece to continue to borrow money at cheap rates throughout the pandemic. The ECB has bought about 250 billion euros in Italian government bonds through that program, just to give you a sense of how massive the support has been. Now that's going away, and some investors do fear that we could be looking at another sovereign debt crisis like what we saw back in 2010.
Quite incredible times, Chelsea. But what kind of impact will this have on everyday investors in Europe?
Yeah, for households and sort of individual investors, small investors, there will be a mixed effect. We've probably all heard over the years investors complaining about ultra low interest rates and how they really penalize savers here in Europe. Interest rates have basically been at zero for years. So if you put money in a savings account, you aren't really earning any money off of that. That could definitely change. And so it could become more and more attractive to make these safe investments and sort of savings bonds. For other investors who are already holding government debt, corporate debt, it will have a negative impact. And households, individual investors are major owners of government debt here in Europe, mostly through things like investment funds or pensions or through insurance investments. The ECB estimates that households hold about 16% of all government debt indirectly. So the value of those investments is falling quite dramatically and likely is going to continue to do so. As well, rising interest rates will mean higher mortgage rates, higher credit card payments, higher car loans. So that's going to hurt a lot of households and individuals as well.
Yeah, quite interesting times for markets. But stocks seem to be staging a recovery. What's driving that?
Yeah, it's really interesting. As long as I've been, covering markets, the rule of thumb has been when interest rates are rising, when inflation is rising, stocks come under pressure. But over the past few days, we've seen really the opposite of that. So stocks are rallying around the world, and investors seem to be betting now that companies can handle higher inflation and much higher interest rates, that they will actually be able to raise prices to offset inflation, and that higher borrowing costs won't really impact them. So some of the best performers we've seen in the German stock benchmark, the DAX, in the past couple of days are consumer companies like Puma, BMW, the online retailer Zalando. So investors do seem to be brushing off all of these risks that are really encircling the global economy right now, not just inflation and higher rates, but of course also the war in Ukraine, which many economists do fear could drive Europe into a recession. Whether this is just temporary or more of a permanent trend is definitely something that we don't have a complete answer on yet.
Right, markets these days not following textbooks. Thank you so much, Chelsea Delaney, right there in Berlin. All right, now moving on. Now we see recent data in the UK shows inflation has hit a new high. Let's hear more now from Juliana right there in the UK. Great to have you, Juliana. Well, UK manufacturers have raised their prices at the fastest rate since September 2008. Seems inflationary pressures are still building there.
Absolutely, and it's this data released by the Office for National Statistics has come right as the Chancellor Rishi Sunak delivers his spring its statement. I think the media are kind of coaxing this as a budget because there are so many expectations, but it is only a spring statement. This is just an update on the government's spending plans. But we got that data this morning showing a 7 percentage point jump between January and February of inflation, 6.2%. That means that everything is rising: food, fuel, gas, electricity, energy bills, and it's only going to get worse. We are starting to see that lots of sectors of the economy, including manufacturing, as you just mentioned, as well as retail and shops, they are starting to cause a lot of pressure, and they are putting up the prices, and it is causing an issue for consumers here in this country. We've heard from lots of different think tanks, particularly the Resolution Foundation today and the John Rowntree Foundation, putting pressure on the government to try and make the burden a little less tougher for families, and that's what we're expecting now. So the Chancellor Rishi Sunak has been speaking at the dispatch box in the House of Commons. He is expected to outline a series of different treats, so to speak, that the government will be giving to the British public. I think the most notable one is relieving some fuel duty by potentially up to 5 pence per litre. Now, that is great because we know since the invasion of Ukraine, oil prices have been surging really high, but then not everybody in this country drives a car. Only about 2/3 of the population do. So there is still a very large chunk of society that, even if they do release fuel duty, are still going to struggle to pay their bills and buy what they would typically buy in the shops. But we'll just have to wait and see what that is, what he does give out today, and we'll update the programme tomorrow.
Right, everything on the rise right now. Let's look at what's happening with Chelsea there. We see a US-based investor, Elliott Management, is trying to hold a small stake. Candy's bid. Tell us more about this.
Yeah, pretty interesting. Since Roman Abramovich was removed as the owner of Chelsea because of his friendly stance on the Kremlin, there has actually been a frenzied bidding war for Chelsea. It is a popular club. I believe they are world champions, though I'm no sports fan, but they've been doing exceptionally well since his 20-year reign in Stamford Bridge. And Nick Candy, who is a British-based billionaire, he seems to be at the top of the list for a potential takeover. Now, the selling price was £3 billion. Last week, Nick Candy put in £2 billion, but his offer has now been helped by Elliott Management, who, as you said, is a US-based investment firm, huge name, big name in the global financing world. They do already own AC Milan. Their hedge fund own AC Milan, and they also have a stake in Series 1 of Club Lille in France. So this is right up their street. Now, this amount that they are going to inject isn't enough for them to be considered a dual owner, but it's certainly enough to perhaps put Nick Candy above any other contender. There is a long list. There is a firm, I believe it's the Rain Group in the UK, that are overseeing this purchase. There have been a lot of mumblings that it's taking them quite a long time to kind of put those huge global interests into a small list of people who will be going into the second round. So I suspect we'll be getting an update from them sometime today or sometime tomorrow of the potential 3 or 4 candidates that could be the next Roman Abramovich of Chelsea Football Club.
Right, all eyes on the Candy's bid right now. But how are the markets looking at it today?
Pretty good. As you were just discussing there with Chelsea in Berlin, there seems to be a rally, even though we know we've got high inflation. Bank of England last week suggests that the 6.2% we've seen today could even go to double digits by the end of the year. That would be a horror for consumers. But investors have brushed this off. Perhaps this has got something to do with the fact that US President Joe Biden will be in Europe, I believe, tomorrow for a huge NATO meeting. And then he'll be heading to Poland to try and broker some diplomatic talks. Is that going to warrant any change? I think fingers crossed if you are an investor. The FTSE All-Share at intraday is up 0.23%. The FTSE 100 is also up by 0.36%, and the FTSE 250 is up by 0.37%. In the currencies market, the British pound is currently trading down on the US dollar by 0.31%, down on the euro 2 by 0.09%, and down on the Japanese yen by 0.60% at intraday, Laddie.
Right, I guess it's a risk on for investors right now. Thank you so much, Juliana. Enjoy the rest of your day. All right, now let's take a look at what's happening in Kenya. I see the Central Bank of Kenya has issued new rules to digital lenders and given a September deadline for license applications. Central Bank of Kenya yesterday informed digital lenders in the East African country that its new regulatory framework for digital credit providers has taken effect. Let's bring in Mercy Milanoy, their business journalist right there in Kenya. Bring us up to speed. Great to have you, Mercy.
Thank you so much, Laddie.
Yeah, so what do the new rules look like?
Well, first of all, there has been sort of a love-hate relationship between digital lenders and, of course, the regulator. And to just give you a perspective of the industry right now, there are about more than 120 platforms you can actually borrow money from digitally here in Kenya. And of course, right now we have 49 digital lending service providers. Now, there was an interesting research that was done by Real Analytics that said about in a group of 100 Kenyans, about 55 have already borrowed from these digital lenders. And of course, with this now with this whole new digital lending thing, you find that it has also increased financial accessibility to very many Kenyans, even in the rural areas, by almost more than 50%. So right now, as long as you have a mobile phone, you have a SIM card, you can be able to borrow money. But now with all this emergence of digital lending, for quite a while, the industry has been a bit unregulated. And the reason why the central bank has actually stepped in, number one, is because there's been issues of unregulated credit providers, the high cost of credit, the interest is quite high as compared to banks, SACCOs, or any other institution. There has been a bit of an ethical debt collection practices whereby, once you sign on to these particular platforms, you surrender your information, your contacts, and these people can call your relatives, your bosses, so those are the issues that have been there. And of course, abuse of personal information, as I have mentioned. But now what the regulations look to bring about is, number one, licensing, governance, and of course, good lending practices, which of course the cost of credit will come to play. Consumer protection, especially of information. If you're not able to pay, how else can they regain the money or talk to you to regain the money instead of calling everybody on your contact list and embarrassing you in front of everyone? And of course, credit information sharing. And of course, an anti-money laundering, because of course it's digital, so money moves a lot around. And this is simply what the Central Bank of Kenya is looking to regulate, Laddie.
Yeah, quite interesting. But do you think these new rules might actually scare these companies away? Maybe they have no way of actually getting their money back at this point if they cannot call your contacts to report you?
Well, currently there's a lot of discussion, not only just for digital lenders, but largely in terms of information, data privacy. There's a lot of conversation going about that. But even mainly the reason why the central bank actually has decided to step in. Number one, it's quite a viable industry. A lot of people now don't have to depend on banks to get credit, which is a good thing. But also it's simply how they're getting their money back. And of course, they've driven a few people to depression. We've seen a lot of cases of depression, of suicide, because if you don't pay, they get to your contact and they start calling everybody. And I think this is one of the main things, especially with personal information, that the Central Bank of Kenya is looking to curb with these digital lenders. Already there are those who had already been licensed, and now they have until September to register afresh for a license. So I hope CBK stepping in will bring in a bit of discipline among these people.
Right. I guess the growth of the digital lenders continue. We'll see how that market continues to grow at this point. Thank you so much, Mercy Milanoy, right there in Kenya.
You're welcome.
All right, so after the break, we'll take a look at Africa's financial system as crypto users grow. That's in a moment. To stay with us. This is Business Incorporated. Welcome back now to our next conversation. Cryptocurrency adoption in Africa is on the march despite socioeconomic factors and headwinds. A report by cryptocurrency exchange KuCoin shows that crypto transactions increased by up to 2,670% in 2021 in Africa. Well, what's driving this? Let's bring in Hakeem Disu, founding CEO Coinwa. Great to have you on the program.
Thank you very much, Ladi.
Yeah,
good afternoon.
Good afternoon, Hakeem. Well, quite a jump in users there for 2021. What do you think drove this?
I'll say firstly inflation, because so many people want to hedge their funds against inflation. That's one of the reasons that brought about the increase in cryptocurrency transactions. And also, how do I put it? Most business limitations on debit card and international transactions actually is one of the things that brought about this impact. For example, most businesses now see cryptocurrency as an alternate form of making payment, and which is like it's cross-border, it's faster, and it's cheap. For example, you can send, you can use 0.01% as a sending fee for your transactions. Also, another reason that I see for this is the fact that according to United Nations, over 45% of the Nigerian population is below 25 years old. This is just to let you know we have a growing population that is smartphone savvy and also digital assets grounded. I think those are the major reasons.
Quite interesting. But how do you see this, impacting, Africa's financial system if these numbers actually continue growing?
Okay, what I see here is the fact that this will impact positively into the financial system of Nigeria, especially Africa in general, because it will help break the gap between Africans and the Western world in terms of trade and payment. And also, according to chain analysis, Africans did over $100 billion worth of cryptocurrency transactions in 2021. That is just to let you know how profitable and how viable the cryptocurrency space is in Nigeria and Africa as a whole. And I think this is like a revenue channel for the African government to reach into to help improve our economy and lift so many people out of poverty.
Yeah, but quite interesting. But how do you think the government can actually make revenue from cryptocurrency transactions?
Yeah, by taxing, bringing out regulations, because this is a space that looks so juicy, even without government impact. Look at the way it's thriving, over 2,000, for over $105 billion worth of transactions in 2021. I'm yet to see an industry that did so much last year in Africa.
Right, and the market is quite young, comes with a lot of risk. Do you think, investors in Africa don't care about the risk, or have they just learned to navigate the market?
There is no wrong or right answer to this. Okay, let's say, for example, look at equity stock. You know, when you buy stock, it takes a lot of perseverance and patience to keep this stock. Over time, it goes up, it comes down. So just see crypto in that light also. It takes a lot of perseverance and patience. So it just part of it to be in it. So that's what I see.
As they call it, a diamond hands. What's your outlook
Exactly.
for user growth? In 2022, we've seen geopolitical tension, inflation still on the rise. At this moment, how do you see user growth for 2022?
We are looking at broader institutional adoption, like broader institutional adoption, sovereign state adopting cryptocurrency, and also regulating it. I think that those are like the major things.
All right. Hakeem Disu, founding CEO at CoinWise. Thank you so much for coming on the program.
Thank you very much.
All right, so as the world celebrates the 10th Global Money Week, which runs from March 21st to 27th, Junior Achievement Nigeria believes that maximizing the theme, Build Your Future, Be Smart About Money, will require a deepening of financial inclusion. Do take a listen.
There was a report by Oxfam that shows that Nigeria actually has a pretty low financial inclusion gap of 40.1% compared to like South Africa, who has 11%. And this is because of lack of financial literacy. So, financial inclusion and financial literacy go hand in hand. You cannot be included in anything that has to do with finances if you don't even have the understanding, the education, the ability to even understand what it's all about. So we believe at Junior Achievement Nigeria that with the right financial education, it actually encourages more people, especially the youth, to plan their financial journey, which obviously will then lead to financial inclusion.
Africa. Now, Egypt plans to raise the equivalent of about $500 million with its first yen bonds. The government seeks to diversify funding for the economy that's under pressure from the war in Ukraine and soaring commodity prices. According to the head debt management unit, the government is issuing a yen-denominated 5-year debt and a private placement that will probably be completed by tomorrow. It will target a yield of between 0.80 and 0.85%. Sumitomo Mitsui Banking Co. is managing the transaction, and Egypt has never sold yen bonds, which are known as samurai deals when they're issued by non-Japanese entities. We see Egypt hiked interest rates in an unscheduled meeting and let its currency weaken on Monday as rising food, oil import costs add to inflationary pressures. Commodity prices have also surged since Russia invaded Ukraine last month. While many countries have been hit, Egypt's particularly vulnerable because it has to import most of its fuel and buys around 85% of its wheat from Russia and Ukraine. It also relies heavily on tourists from Russia. And to East Africa, Ethiopia has constituted a committee to liberalize the banking sector, taking a major step in opening the door for Kenyan lenders such as KCB Group to set up operations in the populous nation. The committee has already started work to amend Ethiopia's half-a-century-old financial code, meaning the long-awaited easing of restrictions on foreign banks making investment in Ethiopia has inched closer. The new code is necessary to cope with the new direction in the economy, and this includes a capital market and opening up of the economy for foreign players. The new financial service code will determine engagement modalities of foreign banks in Ethiopia's financial industry. All right, that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.